We're going to talk about the put-call parity formula and how to use arbitrage with it. So given a basic scenario with put-call parity, we can see we have our call price, which is $3, our strike price, which is $50, our risk-free rate, which is 2%, at time period, which is 1, our price of the put, which is $6, and our stock price at time 0 is $50. So what we're going to do is we're going to plug these numbers in here, figure out what you have to do. Do you have to short, do you have to go long, etc. And then we'll figure out exactly how much money you get and when do you get the amount of money. So let's plug in these numbers. So $3. So just plug into the formula, $3 plus 50 power of 0.02 times 1 is equal to the price of the put, which is $6 plus 50. So on this side we're going to have $52.01, and on this side we're going to have $56. So using this information, this side on the right side is relatively overpriced, and on this side it's relatively underpriced. So what does that mean exactly? That means that here, this side is going to be overpriced relative to this side. Now you can rearrange this formula, but the way this formula is laid out right here is really convenient for shorting and going long with this formula, because you know exactly what you have to do. On this side it means we have to go long because it's underpriced, and this side we have to go short because it's overpriced. If you arrange the formula and you move the put over here, you might be a little bit confused of what exactly you have to do. It's going to be negative on this side, so I guess you can figure it out. You have to go short that, but it's easier if you just keep everything in this kind of order. So now let's deal with what exactly we have to do with that. Well, we're going to have two scenarios at time 1 and time 0. So let's deal with one at a time. So first of all, we're going to go long everything on this side. So what's on this side again? Well, we have our call. So we're going to go long the call. We're going to go long the K. Now, what does that mean exactly? Well, we'll come to that in a second. We're going to go short the put. And we're going to go short the stock. So if we're going short the stock, think about what that means. That means you're selling the stock and you're getting money out of that. So in this case, you're going to be making 50 bucks. And what are you going to do with that 50 bucks? Well, you're going to invest that and you're going to earn interest in a bank. So what does that mean? That means we're going to be lending this out. We're going to take it out of our pockets for now, and we're going to make money of it over time. We're going to put that money in the bank, so it's out of our pocket, so it's minus 50 bucks for now. Oh, let's make that a little more clear. There we go. And short our put, so that means we're going to be making $6, and long our call, which means we're going to have to pay $3. So at time 0, that's going to cancel out, it's going to cancel out, we're left with $3. We're going to make $3 straight off the hop from doing this. Now, are we going to make money or lose money in the long term? Well, we need to figure out what's going to happen later on. So let's do that, shall we? What's going to happen at time 1? Well, either the price of the stock goes down or goes up. If it goes down, and it's less than our strike price, or it's going to be going up, which means it's going to be more than our strike price. So what happens if it's less than our strike price? Let's do this one at a time. Well, our call is not going to be exercised, so nothing's going to happen there. Our risk-free is going to make some interest. How much is it going to make? Well, it's going to make the amount of this up here. Oops. 0.02 times the amount of time. Our time is 1, our risk free is 2%. That's where these numbers come from. You're going to end up with about $51 and a cent. So we're going to, if we put this in a bank account, we're making 2%, and we walk out with this amount. So we're going to make $51.01. Short our put, well, it's less. So this is actually going to get exercised. So first of all, think about what happens if it was a regular put. You pay for put, and then that gives you the right to sell. So what does that mean exactly? That means that we're going to make the difference between the strike price and the current stock. We know our strike price is $50, and we know that the stock itself is some number that's less than the strike price. We don't know how much, but it's less. And you would make that difference. Now, in this case, we're short it, so you just have to do the opposite. It means that the other party on the other side is going to be doing that. And short our stock means that we're going to have to buy the stock back, which means you're going to have to pay the amount of the stock. So we can work this out and see what happens. Negative is a positive, so our stock will cancel out. And we're left with $51.01 minus $50. That's $1.01. Over here, now if the stock price goes greater than the strike price, we're going to exercise our call. And what does that mean? That means we're going to make the difference between the stock and the strike price. So that means we're going to be making the stock minus the strike price, which in our case is $50. That's the amount of profit we'll make. Lending is going to be the exact same as here. We have the exact same factors at play. We just put it in the bank. We made some interest. Over here, our put is not going to get exercised because the stock is greater than the strike price, so nothing happens. And short our stock means once again we're going to have to buy the stock back. So we can work that out, and we can see that our stock will cancel out, plus the stock minus stock, and we're left with the difference between these two, which once again is $1.01. Now we're almost done here. The only thing we have to do left is to figure out exactly what do we want to do with this. Are we looking at the present value at time 0? Are we looking at the amount of money at time 1? Well, logically, it makes sense to think about how much money you're going to have at the end of the day. So for now, let's say at time 1, how much are we going to make? So in other words, we know we're going to have $1.01 because that's how much we're making here. So how much is this amount worth at time 1? Well, all we have to do is figure out $3 times our risk-free rate, because we're going to take this money, put it in a bank account, and make 2%. So we'll have 2% times our time. Our time is only 1, if you remember up above, times 1. So what is that value exactly? Let's see, 0.22. So $3.06. So at time 1, our total value is going to be $3.06 plus $1.01. That's $4.07. Now if we step back a bit, we can see exactly how we did everything here. So what did we do? In the beginning, we identified our formula, we plugged in our values, and we saw that this side was relatively underpriced compared to this side. So we knew we had to go long on this side and short on this side. Alright, so far so good. What does that mean? That means we're shorting the call, and we're going to be lending this amount. We're going to be going long our put, and we're going to be going short our put and short our stock. So what does that mean? That means at time 0, we're going to be making this amount of money, and we'll stick this amount in the bank account at a risk-free rate. At time 1, we're going to be making this amount of money if the stock price goes down under the strike price, and if the stock goes greater than the strike price, we're going to be making this amount of money, and it should be the same amount. So then we just have to add them up, and we can figure out the total amount of profit that we made by going about our strategy. So that's how you use the put call parity formula and how to use it in the terms of arbitrage.